This is a preview video. Thanks for joining us here at XM.com. The Fed has been reiterating its higher for longer stance with every opportunity, but markets don't seem to listen and they continue to price in rate cuts for 2024. But can this week's core PCE inflation data bridge this disconnect? I'm Christina Marujas. With me today is our lead investment analyst, Rafi Boyadjian. Rafi, core PCE inflation data is out on Thursday. It's expected to maintain its downward trajectory, but is that enough to warrant rate cut expectations?
Well, that is a very good question, Christina. As you said, we are expecting to see a further decline in the core PCE. Of course, this is the most important metric of the US inflation. This is the one that the Fed pays the most attention to when it comes to whether or not it thinks it's hitting its 2% target. So last month, it had declined to 3.7%. We expect to see a further drop to 3.5%. And all of this would kind of support the picture that inflationary pressures are subsiding in the US, where we are well on the way to getting to that 2% objective for the Fed. And of course, we are seeing some moderation in economic growth as well. Of course, in the third quarter, we had that near 5% annualized growth rate, which was exceptional at a time when supposedly monetary policy is tightening. But now we are seeing signs that the economy is cooling off, which of course would be good news for inflation and in turn for the Fed. So we're also going to get alongside that core PCE numbers, the personal income and consumption data. We expect to see personal consumption rising by just 0.2% month on month in October. So that would be basically point to moderating growth, but nothing too worrying as far as, the US heading towards a recession.
And now let's turn to the market reaction. We saw the dollar weaken on rate cut expectations these last few sessions. How could we see it perform on the PCE inflation data?
Well, the dollar really has been under a lot of pressure lately. We are seeing Fed rate high expectations actually being ratcheted up overnight because we had some surprisingly dovish remarks from Fed Governor Christopher Waller. He basically said that if inflation continues to come down at the current pace, then maybe in 3, 4, or 5 months, the Fed might be in a position to start cutting rates. So this is actually a pretty significant dovish tilt from one of the Fed's previously more hawkish members, and it kind of supports where the markets were in their thinking, which until recently Fed officials were kind of pushing back on. Of course, we are also going to be hearing from Powell later in the week on Friday, and of course his comments will be more important and will be the last clue before the next FOMC meeting on December 13th. So after Friday, the Fed's going to enter its blackout period. So the dollar, it's really, if Powell strikes a similar tone to Waller, it's hard to see the dollar recovering anytime soon because, of course, although we've got rate cut expectations for other central banks, the Fed did raise more, so they seem to be cutting more. On top of that, lately we're seeing a bit of a hawkish pivot from, say, the central banks in Australia and New Zealand, and Bank of England as well, not so much another rate hike, but pushing back against rate cuts. So that really does paint us a picture of ongoing pressure for the US dollar, at least in the near term.
Rafi, thanks so much. This was a preview video. Thanks for watching at XM.com.